All right, guys, this is being recorded. And of course, I say this at the beginning of every single webinar is watch this again, whether it's this specific one on implementation of options to a portfolio, because this one I'm going to be specifically talking about how we can put something like this into a portfolio. A lot of times in some of the other webinar or in the other courses, I'm talking about trades around this. So this is more a longer term portfolio type thing, or a risk adjustment to maybe a position we already have, because we just did one on the synthetic shorts, and this could be a hedge to that if it started going against us and we still believed that our assumption was right. So anyway, without further ado, this is Bullish Risk Reversal, and for implementing this in and around our portfolio. But let me get a couple of things out of the way real quick. My name is Eric Wilkinson, and yes, you very well may recognize me from mainstream media as a Wolfman, where I've talked about everything from economic to geopolitical and market analysis. I started trading in college well over 25 years ago, and I've traded everything since then, from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. And please pause this or read over this really quickly. It basically says any opinions, news, research, and analysis, or anything I talk about in here is not to be constituted as investment advice. Specifically, when I'm talking about how we implement this around a specific underlying, I'm not necessarily saying go out there and do this tomorrow. It might be counterintuitive to what's already in your portfolio. So take what we teach you in this and implement it into your portfolio in your own way. And please remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right. You can follow me on Twitter at Wolfman's blog, or our parent company at ProTrader Strat. Facebook, we're putting out a lot of content there. We were doing it on YouTube. We still are doing it on YouTube, but I think you get easier access to it on Facebook at ProTraderStrategies.com. There's a lot of people are on Facebook throughout the day and not really on YouTube. And I don't think YouTube pushes it out there as easily accessible. All right, this is on the bullish risk reversal, and something to note with that, we need to come up with a market assumption, right? Well, I kind of gave it away with the bullish risk reversal, but the risk reversal sounds weird. And the reason why they call it a risk reversal, you guys, is because it is, generally speaking, a risk reversal, quote unquote, is for the downside, but you can build this for a bullish upside. And we want to have a bullish assumption, but you can get away with a neutral assumption. It's the way we're going to build it out, or the way I'm going to teach how to build this out. You're going to be able to hold this strategy even if the underlying stays right where it's at. You're not going to make a ton of money if it sits right there where it's at, but at least you're limiting your risk in a sense. So we're going to be able to build this out for a neutral, but we really want it to be bullish, but you're not going to be hurt if it is neutral, is what I'm getting at, I guess, at the end of the day. And we're going to be buying an out of the money call, and we're going to be selling an in the money put. And one thing to note with this is we're going to be trying to build this out. Now, if you guys will watch, I see there's a lot of returning faces here. You know, with that synthetic long, we were talking about 100 deltas, right? We were trying to get long 100 deltas there. Well, with this one, we're going to be able to limit some of our risk. So what I was talking about with, like, if you have an underlying and you have 100 of that underlying, okay? So in your portfolio, you know, you have 100 of X, Y, Z. Well, with this strategy, you could be able to do it if you had a limited portfolio value and you aren't able to buy 100 of the underlying, or maybe even, you know, do the 100 deltas. Sorry, I don't know what just happened there. I think I clicked my thing a little bit. Hit my cursor button. Let me give it a different pen that doesn't do that. All right, so we were talking about 100 deltas, right? So we're looking at 100 deltas. With this one, we're going to be able to do it at 50 deltas. And I think I had it on this page, actually. So we're going to be looking to build this out at 50 deltas. So in that, I'm going to give it away a little bit early, is this one's going to be 25 deltas, or as close to it as we can. We're not going to always be able to get exactly 25 deltas and 25 deltas, but we're going to try and build it out with the at the money call, where we are looking at the 25s, okay? and out of the money, obviously, because we're talking about 25 deltas there. And what that's going to do is create a risk parameter at the end of the day that kind of looks like that, in a sense, where, you know, this was our neutral. We're not going to get hurt in here. To the upside, we'll be able to make money, and to the downside, it's going to lose money. So in that, it's very similar, make sure we note, similar to the risk reward of a long stock position. The reason why I have similar there is because of that end of the day, you know, if we took this into expiration, there is a swath there where, you know, we're going to be able to make little or no money at all on this trade. So I kind of mentioned it a little bit, got it out of the way. This is on Deer. So we're looking at Deer and looking at the 160 puts. These are the ones that we're going to be selling. And we got 25 deltas. Now, just a little bit of a review for some people that might be new. One thing that delta tells us is for every dollar move, and we got 29 deltas over here. So that's kind of what I was talking about. It's not going to be perfect all the time. But if we're looking at this 29 deltas from the upside, if this underlying goes from 173 to 174.05, well, this premium over here is going to increase by that 29 cents. So that first dollar move. You can see delta over on the puts is negative. That's because we're assuming a positive move, and it would decrease these by 25 cents. All right. That's one thing that delta tells us, but there's a lot of things that goes on with that. So if we had that dollar move higher, we would have this 29 delta helping us and this 25 delta helping us. So we would get an adjustment of 54 deltas. So that's what makes it equivalent to like 50 lot in the underlying, right? If we bought 100 of these and it increased by $1, well, we would have gone up by $100, right? If it was equal to 100 deltas, all right? Now, if we are increasing our position by, or we see the underlying move by $1, well, it only increased by $50 because, or sorry, $54, I should say, $54 to be exact, because 29 and 25, 54, right? So our position would have increased by $54. Well, that makes it equivalent to 54 deltas or a 54 lot. It would have been like we bought Deer 54 times. Sorry about that. It looks a little like a 6. 54 times, it would be bought Deer, 54 times at 173.05. Does that make sense to everybody so far? I know I got a little wanky on that one, back and forth. Does everybody get that, how that works out that way? I don't want to lose anybody right off the bat. Because if this increased by, if this increased by a dollar, right, and our position only increased by the 54 lot, all right, we would have gotten an increase of $54 in a sense. So it would have increased by $54 also. So what we're doing here is we're trying to cut a synthetic long in half in a sense. So if you have a smaller portfolio, this is great for that. Also, if you went along with the last week's trade and we did a synthetic short, right? Well, I did it in Boeing. Well, and Boeing's kind of trickled up a little bit. I had a big drop, but now it's starting to trickle up. Well, if I started being concerned about that move, still had a bearish bias, maybe I'd want to shave my position in half, right? So if I did a bullish risk reversal, that reverses my risk on this downside move, right? So I'm bearish. I've got a bearish position in something, bearish position, all right, in Boeing, and it's gone down. Now it's starting to trickle back up. Well, I still believe that it is, you know, I'm still under the guise that it's going to go down, but maybe I was worried about wanting to limit some of my risk to the upside, and I could put on this bullish risk reversal, okay? and it would cut my position in half. I'm short 100 deltas in BA right now. I wanted to do a risk reversal on this, cut that position in half, but not really get out of it. Maybe I just want to take advantage of this upside move, cover that, cover my bullish risk reversal and wait for the market to drop. But maybe it's just moving up for some apparent reason. Another thing would be you didn't want to get out of that position for capital gains or something like that heading into the end of the year. You're just not ready to get out of this short position right away. Okay. So something to note, I got to go over real quick. And keep in mind, you guys, the risk profile on this to the downside, it's considered infinite. It's basically to zero. Our risk profile is when this underlying goes to zero. Whoops. I want to go to this one. Sorry. Our max law, or sorry, it's not to zero. I'm thinking of the regular. We're doing bullish. So our upside is infinite because it can go to 1 million, right? Our max loss is if the underlying goes down to zero. Sorry about that. So we have unlimited upside. One of the nice things about this one is that, we're starting out with, in that one case, we were talking about 54 deltas. Well, the higher this goes, if deer were to go up to say $250 or something like that, our deltas are going to slowly start increasing. So if we were at $250 in deer, I might be up to about a 95 delta or something. Okay, so as this market goes in our direction, it is going to increase in delta, and vice versa to the downside. The more it goes down, our deltas to the downside are going to hurt us a little bit more as well. And I'll show you guys all that when we pull up the platform. All right, so our break even. One of the things we want to do is we always want to do this for a credit or for zero outlay, all right? I don't like to do this for a debit, if at all possible. I try and build it out so that I get a credit. The reason why is because we're buying a call, right? We buy a call and we're selling a put. Well, I want my break even to be, up higher, all right? I want to be able to have this market go up, right? So, or our break even to be lower. I'm sorry, geez, Eric, get yourself together. I want the market to go up. So I want my break even to be low where I start this trade. And if I do it with a credit, it's the put strike minus the credit. So if in this case, it benefits to buying a leap call on a bullish. Yes, it is. And you're talking about the deltas increasing as the market goes in your direction. Yes, it's going to act similar to that. But if it's the put price minus the credit, think about that. Then my break even is way down here on the puts. But if I do it for a debit, it's the call strike plus the debit. So my break even is above where I need to go. I want that break even below where we're starting out. So back to that deer position that I kind of had thrown up in this example here. If we look at this, the 185 calls and the 160 puts, well, I got a 35-cent credit, right? So that means it's 35 cents minus those puts. So when I pull up the Analyze tab, I've got that 35-cent credit down here. So my break even is down here at the 165 minus the 35. So at 159.65, my break even is 165. Jesus, I'm getting so ahead of myself, you guys. I can't even help it. I shouldn't have drank that espresso right before I did this webinar, I guess. Actually, you would have thought it would have woken me up a little. All right, so 159.65 is our break even. It's just slightly below our put strike there. All right. Whereas if we had done this for a debit, then our break even would have been up here. All right. So we would have had to move higher. Now you're looking at this where you don't make any money right here. Well, remember, this is at expiration. And you would still be able to keep that 35-cent credit if it stayed within this parameter right, you would be able to keep that credit. Another reason why we wouldn't want to do it for a debit, because then we would have lost that money. Our break even would have been below the positive negative inside of this swath between our two strikes. So definitely want to build this out for a credit or zero outlay of dollars, all right? Because we want to be able to capitalize if it stays within this range. And you can see here the purple line, this purple line along here, that's as if you were to have bought the underlying outright. So what I was talking about is, yeah, down here you're only getting like 50 lots or 50 contracts, but the higher it goes, it catches up to it. It's never going to go over what the underlying would be doing, but it can catch up to it, and vice versa to the downside. It can catch up to it to create that 100 deltas as well. You know, if you were to start losing on the downside. Now, before we put this trade on, a lot of you guys I know watch other people. God forbid. No, I'm kidding. But some of you guys will watch other people, or you guys come up with your directional assumptions somehow. Well, not every underlying is equivalent. Some underlyings we don't want to trade options around, all right? And when we're looking at an analysis of this underlying, well, we come up with this bullish assumption on it, and all of a sudden I say, well, can I trade this bullish risk reversal around it? Well, when we go to the option montage, which is basically just looking at the platform, when we pull up our platform to trade, and we get over into the option montage, which is just this trade area, we want to go to where 35 days to expiration is the closest. This is the spot month, closest to 35 days to expiration. That's just where the most traders are getting involved, all right? And if we're looking at 3M, for some reason we have a bullish assumption in here, what we need to do is for any stock that is, if it's greater than $100 stock, all right, we need to take that decimal and move it 3 ticks to the left, all right? So then that would equal 10 cents, all right? So when we're moving that decimal on this one, I move it 3 ticks to the left, 1, 2, 3, I've got 17 cents, right? Now I need to take that idea and bring it down to the options that are in the spot month, closest to 35 days to expiration, and check all of these. Is that within 17 cents? And this is during open market operations when everybody's got their trades in there. And if it fits that rule that it is equal to or less than 17 cents, then that fits the rule, all right? That says, all right, you can trade options around it. Now, you can stretch this one just a little bit on these because we can price it in pretty closely to where the underlying is trading. So we don't have a whole lot to worry about that. But in this regard, make sure when you're a newer trader that you always, if you're trading options, just check that rule. It's a really important one to go down there and check it, all right? And then when we go over to looking at our strike location, so, you know, these are my rules. They aren't necessarily hard, fast rules, but they're a guideline to make sure you guys are making the right choices on this, all right? So we've come up with a bullish assumption in XYZ. We realize, okay, it makes that rule that if it is greater than $100, we just move the decimal. If it's less than $100 stock, all right, basically it needs to be equal to or less than 10 cents wide, all right? So if it's less than $100 stock, equal to or less than 10 cents wide on that one. All right, and the right strikes. I've mentioned this several times. What we're going to try to do is make this equal to about 50 deltas, all right? So that's going to determine our strike locations. You know, those are those out of the money call and out of the money put. And, you know, just as important as that, we want to do it for $0 or a credit, all right? So we need to build it out for $0 or a credit. I think that that is really important as well for picking these strikes. Yes, you can do it as a debit, but, you know, when we're building this out, if we can get that credit and get our break even below, give us wiggle room to the downside, then why not do that, right? Why make ourselves swim upstream to get to that break even that's up and above us? When you have a minute, could you clarify, would you do a bullish risk reversal? Why would you do a bullish risk reversal? Is it when the price is going up but takes a dip? On a bullish risk reversal, it's for a bullish, we're looking for a bull move, all right? Or you're trying to hedge a short, all right? So the idea is, you can build it out as just a bull position, and you don't want to do 100 of the underlying, okay? If you're somebody that has less than $100,000 in your trading platform or in your portfolio, this might work out really well. Maybe you just wanted to add, you have 100 of XYZ in there and you want to do dollar cost averaging and just add like 50 increments of 50 contracts to that, right? Because, you're limited on capital, especially if you're less than $100,000 portfolio and you're down into the like $10,000 portfolio. I always say you want to have as many opportunities out there in your portfolio because they don't all work out at the same time. And this is a way to help you diversify that portfolio when you're struggling with limited capital. If you have $1 million in your account, then you're probably not dealing with the 50 delta type things. I mean, you can do more contracts that increases your deltas. It allows you, the other thing is it gives you that room to, if your trade is just kind of, your underlying is just kind of doing that, you're still got bullish, but I want to collect 35 cents or 50 cents for this because I believe it's going to get stuck in a range. Well, yeah, you can do that too. So there's a lot of different scenarios where you could put this on, but know that you are ultimately a bullish position. You could hedge a short on it. If you're short, like a synthetic short, like I talked about last week with Boeing, and it's starting to migrate up a little bit, well, you want to cover some of your risk, maybe lock in some of your profit, but you're ultimately still bearish. You think it's going to maybe rally up and then drop off. Well, you can take advantage of that move with this bullish risk reversal and hedge some of your position. Does that make sense? Or you want a dollar cost average, slowly add it in. I like my bearish trade is going bullish. I can use this. Yes, absolutely. I was thinking about actually putting this on for my Boeing trade that I did for the synthetic shorts, but I probably waited too long. I was thinking I might be able to wait until this one to do it, but I'm going to continue to let that one ride out. So there is also a bearish risk reversal strategy. Absolutely. I'm going to be doing that one next week and, for hedging portfolios as well. All right. And then the right duration. One of the beauties about the bullish risk reversal is usually there's put skew going on, which means the puts are a little bit more premium in them. So with the put skew, this is a little bit more attractive in that sense to put this on because you're able to put those puts on further away from where their underlying is trading. Volatility is so low right now, it's almost neutral skew where the premiums aren't pumped into the underlying. Now you can do this. It will work out for any duration, you guys, but why not give yourself enough time to be right? I don't stay in trades longer than 6 months. So I'm usually looking at around that 3 to 6 months. So the right duration for me is 3 to 6 months out. All right. And the reason why you get out, if you're out 200 days, those markets get really wide. All right. And there's not a lot of participation in there. It's kind of difficult to get in it. Also, with a bullish risk reversal, my thought is you're just trying to hedge something in the short term. You're still continuing to believe your assumption in this underlying is correct, meaning to the downside, but you're worried about this correction, or you want to limit some of that. Don't want to take capital gains heading into the end of the year, right? All of those things are ways to hedge a portfolio. All right. And if I just had a bullish assumption, I'm never thinking further than 6 months out, usually anyway. I'm looking for in and out trades. So I'm usually looking at the 3 to 6 months contracts. Now, keep in mind, our duration is that 3 to 6 months contract, but when we're picking the right underlying, we still got our eyeballs on 35 days to expiration, okay? We're still looking at that, even though when we enter this trade, all right, when we're going and checking this out, these are the 3 to 6 months out, which is going to be, your 90 plus days to expiration, all right, on your duration, all right? All right. If you guys like going further out, then that works too. But for me, the right duration for me, I'm not in anything longer than 6 months, hopefully. And if it is, it's probably because the stock got put to me. All right. And the right environment. One of the beauties in this is, we've talked about this, the right environment. I usually like to get middle of the road. So somewhere between, 30 IV percent to about 60 IV percent, really. And you can do it again with any implied volatility percent. If you're wondering what implied volatility percent is, I'll go over that in a second. The reason why I like this middle of the road is because if we have 0 IV percent, I think there's better strategies out there, possibly. The man who talked about buying the calls and stuff like that, yes, then I'd probably go out there and maybe buy some calls, because then I get help from volatility increasing. With this one, we are basically isolating volatility. We're not going to have a whole lot of vol exposure. And if you're newer to options trading, let's pull this back up. And we're going to be able to negate a lot of the ill effects of all of these things like theta and vega. If you're not used to trading options and you're worried about all of these, just remember delta, we talked about it, that's dollar number one. And gamma goes with delta on dollar number two, okay? Basically, gamma adds into delta on the second dollar move, all right? So you can kind of predict where your premiums are going to increase. The first dollar move on this one, let's just look at this as the 180 calls. We're going to look at this one here. First dollar move, our delta is saying it's 20, right? So our first dollar move on that dollar number one, our premiums are going to increase to now, if we go middle of the road, saying it's $1. Just for math purposes, let's just say we're looking at $1. Our second dollar move higher, now that premium is going to be worth $1.20, all right? On the second dollar move, right? On the second dollar move, I said gamma goes with delta. So this 3 cents adds into that. So the second dollar move, it's going to increase by 23 cents. So it's going to go from $1.20 to now $1.43. So gamma goes with delta. This is all going to help us in this strategy. But if you look at theta, theta is going to hurt us over here, right? Because we're going to be buying this call. So theta is going to hurt us. But over on this backside, if we look back over here on the backside where we're going to be doing maybe the 160s. So if we did the 180s on this side for the 20 deltas and the 160s over here, that's probably too low. But the 165s, we'd probably go a little bit tighter than that. But you can see that the theta is offsetting pretty much. We're going to be helped out actually by 1 penny, but you can see they're very close. And the volatility is 15 here, and the volatility here is 14. So we're going to be offsetting them, right? Because remember, when we're over here, we're going to be buying the calls here, and we're going to be selling these. So if the market goes up, let's just assume we go up by, $1, just to keep math simple. We know the delta goes in there, so we've gone from $1 to $1.20. So we go from $1 to $1.20. Well, we sell the, we're selling the 165s probably. And we're selling the 165s. So if the market goes up by $1, you can see delta is negative. That means these decrease by 22 cents. All right, so these are going to go down to $1 right middle of the road. Let's say it's $1.25. These are going to go down to $1.03, right? Well, if volatility over here, this goes from 21.29 to 22.29, all right? Vega says for every 1 percentage point increase, this line over here is going to affect the premiums by the corresponding amount. And remember, this is in cents over here and same over here. So if it increased by 1 percentage point over here on our calls, it would increase by 14 cents, right? Well, that increase helps us because we bought these. We want these premiums to increase. So that would help us. Over here, that increase is going to hurt us, all right? Volatility increasing, this is a positive, so it would hurt us by 15 cents. So it's going to totally hurt us by 1 penny, all right, if volatility increases by 1 percentage point. Vice versa, if it decreased by 1 percentage point, we would subtract it, right? Because a negative plus a positive is a negative. So a negative to volatility means the premiums come out of there from the section over here, all right? Is everybody following me there? And if volatility decreased, then these are a positive. A negative plus a positive means that this would decrease by that corresponding amount, okay? So you can see that it's pretty much offset based on the volatility. And the theta, theta is offset also. We can look at theta over here. And if we were looking at these 180s, you can see theta hurts us every day by 4 cents, right? And then over here, because we bought it, we want these premiums to go up. If they start decreasing because we bought it, it's worth less, so it hurts us. But over here, we sold these 165s. Well, theta is a 5. So if every day that goes by, this decreases by 5 cents, that helps us. So again, offsetting for the most part. The volatility and they're off by 1 penny. That isn't a whole lot to be worried about, to be quite honest, all right? So that 1 penny is not really going to make that much of an adjustment. How did you get from $1.03? Shouldn't you be buying 97s? If you're talking about the premium over here, 97s, I'm not sure what we're talking about. Are we talking about the premium here, John? No, the delta. The delta on these is 20 cents. I was trying to just make the math easy. Yeah, you're probably right. If you're talking about 97 cents being middle of the road, and on the put side, if we're talking about the delta, it's 22. Right? So if the market goes up by $1, these are going to decrease by 22 cents. Oh, so 125 minus 22 is $1.03. What did I say? Did I say 97 cents? If I did, I'm sorry. Yeah, if the market goes up by $1, and we're looking at these premiums right here being 125 middle of the road, the this is delta. So we are going to see these decrease by 22 cents. So going from $1.25, let's say that's middle of the road, decreasing by 22 cents, we would get $1.03. So if I misspoke there, okay. All right. All right. So that's, a couple of those things. The environment, I like, the sweet spot for me is to pick these that are, in this implied volatility percent. And for some of you guys that might be newer to options trading, implied volatility percent is really just a gauge as to where implied volatility is in relation to itself. Implied volatility is forward looking, and what we're trying to do here is to get a gauge as to where this volatility coefficient for 3M 21 is in relation to where it's been in the past. And what you're doing here is you take the current implied volatility and subtract that by the low implied volatility, and you take that sum and divide it by the high implied volatility minus the low implied volatility. John, I see your question. Just give me a second here, and I'll try and touch on it. So what we do is we take this market here, and we're going to be looking at it. I probably should have checked what the high is. So now we know we need to find the high, which is 39, the low, which is 16, and the current is 21. All right. So we take the 21 minus the 16 and divide that sum by the 39, which was the high, minus the low, right? So this is the current IV minus the low IV. And take that sum and divide it by the high IV minus the low IV, all right? So that's what we've got here. So basically we're looking at 5, right? 5 divided by, what is that, 23? So 5 divided by 23 is basically the 20-ish. Somebody probably can do the math faster than me in their head. So that's basically 2, 5. So we got 6, 4, 2. So 2, 1, something or other. All right. Yeah, it's about 20. So it's, the 21-ish IV percentile, which is pretty close to where I was talking about it. But like I said, we can do this in any environment because we're offsetting it. It's just that when implied volatility is super duper low, I think that there's higher probability strategies that I will teach that I would implement in. And if it was super high, there's other strategies for a bullish assumption that I would probably implement in and around this. But if you're trying to hedge a portfolio, this is one of the better ways to hedge that portfolio if you had a bearish or a short on, okay? All right, and then our exit strategy. Know your ins and outs. We're going to look at knowing our exit strategy before we even get into this trade. Everybody's risk parameters are different, but what I like to do is if I was looking at this one, I would say if I was bullish in this, I would have a profit target of saying, I think 3M is going to go to here, let's say, for, lack of anything else. I think it's just going to go to here. But if it breaks this area, I'm going to get out. All right. So know your exit strategy on the downside, however you come up with it, and know where your profit target is. So in this case, I'd say, I'd write it down at $188. I'm out for a winner, and then for the downside, if it breaks basically 162.5, I'm out. All right. So that way, when you're getting into these things, then basically you will not be playing around with it. It goes down to that area, you get out. The thing that I see so often is when people come up with their targets, it gets there right away, and they're like, "Oh my gosh, this has happened so fast." Well, I'm going to squeeze it out for a little bit longer. I'm going to stay in this because it's going to go to infinity and beyond. Well, a lot of times, if it's moved that fast and hit your profit target, it's probably going to correct it a little bit. And why not take it off at your profit target, reevaluate it, maybe later on, just keep an eye on it or something. And when it corrects, get back into it. But always write this stuff down because you're more likely to stay mechanical. I try to take the emotion out of trading. And one of the best ways to take emotion out of trading is to write this stuff down. All right. And you will more than likely get in and get out where you've said if you've written it down. If it's just in your head, you're going to have a tendency to, all right, well, maybe I'll just wait till it breaks below this now and breaks below, and it does, and then I'll wait till it breaks below this. And then you're like, well, if it breaks below the new low, well, you said you were going to get out way up here on a loser. Get out on the loser where you say you're getting out, and get out on the winner if it goes up there and hits that. All right. So write that stuff down, and it will help. The call side delta change. I'm not sure if I answered your question yet on that, John. I'm not reading it. But one of the things I was going to say with the delta change, and I keep looking at the 129s, we're going to be looking out here in like the March or April contracts to actually implement this strategy for those deltas. But one of the things I want to note is, if let's just say I put this on 3 weeks ago and I had used the 145 calls, you can see that these deltas are increasing quite dramatically. I went from 50 deltas, now my calls are 85 deltas, right? So my puts would have been down here, say the 125s. So, even more so, 85, I'm almost at 90 deltas. So that's how it starts catching up to dollar for dollar the more I am right, as the more I'm right. And vice versa, the more I was wrong, the market went down, which now it's at 172 or whatever, but I put it on when it was trading 200. You can see those put deltas are hurting me almost dollar for dollar as well. So keep that in mind. The further we're right or wrong, our deltas are going to constantly adjust. But in the beginning, when we set this up, it's highly unlikely it's going to move that far, that fast, but it can. And you need to be aware of those deltas will constantly be adjusting the more and more you're right or the more and more you're wrong. Okay. It'll help you out when you're right and hurt you when you're wrong. Is the put side negative delta change? Yes. Okay. So the put side, I think I got you. What we're going back to is the calls and the puts here. All right. So we're going to talk about this as if we were looking at 3M. All right. So I'm trying to pick the ones that are closest to 50 deltas, right? So I'm going to say, let's just look at, I would do this one because it's 21. So I'm doing the 155s on that side, and I'm going to do the calls for the 28s. That's close to, that gets us to 49 deltas, right? 49 deltas. The reason why is because we're buying this. We're buying these calls. We're buying these calls, and we're selling these puts. So the puts are a positive, and then the deltas on the downside is a negative, but I'm selling it. So a negative plus a negative is a positive. And the reason why all of this stuff is based on the assumption it is moving higher, okay? All of these things are for a plus to whatever, okay? A plus to volatility, a plus to theta, right? Every day that goes by is a plus. A day that goes by is plus 1 day. Well, plus 1 day means theta is negative, okay? That's why theta is negative, because it's plus 1 day. You don't go backwards. Delta is on the thought that it's plus $1, okay? And plus $1, okay? Sorry, I went backwards there. And that's why that's a negative, because the assumption is plus 1 day, or $1. If you had a negative $1, well, a negative plus a negative is a positive. All right. So if the market goes down by $1, these are going to increase by the delta. All right. That makes sense? How that works out? And all in all, if I was positive these and the market went down by a dollar, these are going to decrease by the corresponding delta. All right? If the market decreases by a dollar, these are going to increase by that percentage. Okay? But all in all, if the market went down, if we went down by $1, then our total on the first dollar move, our trade would lose $49 because this acts as a negative and this acts as a positive. Now remember, the risk parameter on it looks like that, right? Where there's a swath in there. But remember, this is at expiration. During the life of this trade, if it goes up and down by a dollar, then our premiums are, or our trade is going to increase and decrease by those deltas. You don't add the call side and the put side for every dollar increase or decrease. Yes, you do, because we have a total deltas, right? It's all on our total deltas. When we buy, here, let me actually pull up a real trade and we'll go through it. All right. And I'll be able to show you. All right. So what we do, I want to look at TLT because I think TLT is overdone to the downside. I think TLT is ready for a bounce. This is my own personal assumption. So I want to look at TLT. Now TLT, $136 contract, move the decimal 3 cents or 3 decimal places to the left, 13 cents. You can see that fits the rule, 29 days to expiration. I'm going to be looking at the March contract. All right, so I want to get to close to 50 deltas as I can, and I'm going to be looking at this contract right here, and hopefully I'm going to be able to get a credit for it. So I'm going to sell these. It's a little bit more. I'm getting 27 deltas there, but I'm going to go look and buy these here for the 25 delta. So let's negative this thing down a little bit. All right, so I get a 12-cent credit, so that follows my rules, right? Now, I bought these calls, all right? So this is going to increase by, this call for every dollar move higher will increase by 25 cents. For every dollar move higher, these premiums are going to decrease by 27 cents, all right? So if I started out with this trade, you know, it's a 12-cent credit. And then I pull up, let's say it increases by $1. And I basically got into this one, middle of the road, I'm going to say is $1.20, right? So let's just say I got filled on this one at $1.20. This one I'm going to say is $1.27, middle of the road, right? When I got in, those are my strikes. If it goes up by $1, this premium is going to increase to now $1.45, all right? And that dollar move higher, these are going to decrease by that 27 cents, which makes that $1. All right. So I got into this trade for a total of credit 12 cent, which doesn't make sense that if I use those two strikes, right, that it's 7 cents. But now it's at a 45-cent credit, right? Because if I sold those and bought these back out, I would get total of, sorry, it's not 45. Yeah, I'd get a total of 45-cent credit. But what I would see happen is I bought them for $1.20, sold them for $1.45, and sold these for $1.27 and bought them back for $1. So that increase is 45 cents, right? And, you know, I built it out to be 50 some odd delta. So it's very close to that. My math is what's throwing it off by rounding off and everything. But we can also go over here and look at this. This might be an easier way to do it. Let's just go over to theoretical mark and change that. Let's just reset it. So we can look at it this way too. Let's just say the stock price adjusts by $1. So it goes up by $1. We can see that that corresponding, we said that these strikes were the 142s. They increased by that 20 some odd cents. What is that? 29 cents or something. 27 cents. There, and then these decreased by that corresponding amount. The strike is 103, and I think these were the 25 deltas, or sorry, it's 128, and basically a 25 delta, so it decreased by the 25 cents. All right, so our premium would have adjusted accordingly. All right, cool. So this is the trade I'm going to be looking at, you guys, and we can go over here and, you know, I showed you just now, like nothing goes by. Even if a day goes by, we can increase the day, say it happened tomorrow. This is going to take into account the theta and all of that stuff as well on the premiums. So, you know, keep that in mind. But know that every dollar move higher, these are going to adjust, despite the fact that I go over here and look at the analyzed trade. And you're like, oh my God, I don't make any money until it gets all the way up to 142. No, what this is saying is at expiration of the March contract, these are where your, you know, line in the sands are. You can see that I get to keep that 11 cents. My break even is the 132s minus that 11 cents, bringing that down to 89. Okay, so you know, I'd much rather have my break even to the downside from where I got in at inception. If I go like this and make this into a debit, you know, if I just happen to set it up as a debit, you can see now my break even jumped all the way up here. All right. So that's at expiration still, mind you, that if the markets continued up during, you know, started increasing tomorrow, then I wouldn't necessarily have to worry about it until the expiration happened. But, you know, why not set yourself up for success if the underlying never moved, that you'd be able to get that 11 cent credit and never have to worry about it, right? How did you pull up the theoretical price menu? Well, with Thinkorswim, you can pull it up through this. And it's got a theoretical, Theo, price, and mark. And then basically you have to click over here right next to it and get the drop down window. And you can adjust volatility. I can see what happens with volatility increasing, how it's going to affect my premiums and everything else. So you can play around with that and you will see that it doesn't show the delta and all that stuff, but you'll see that it follows suit with that. Pretty helpful tip if you want to play around with stuff like that, that you can see that it's not going to, you know, as this one, you know, if I went from 0, right, and I increased it by, let's just say we get rid of the dollar and the day. Let me just reset it. So this is constant, 129, 118, right? And we can say that this just increased by 1 percentage point and hit enter. We can see that we would see that this is basically offset. All right. Our premiums increased here. That helped us. Our premiums increased here. That hurt us. But they are basically offsetting from the volatility. All right. Do you ever close only one leg? Banu, I would probably, if this really started rallying, yeah, I would probably cover those puts. If it really started rallying right away and I could cover these puts for almost 0. If these puts are worth, you know, if they've gone from $1 to maybe even 25 cents, I might even cover that trade because, you know, it's gone so much in my favor that the only thing at that point, I mean, for 25 cents, it's probably, it can only hurt me at that point, right? So yes, if this started approaching, you know, higher deltas, maybe it started becoming a 50 delta or 60 delta, these calls went in the money, then that's probably at that point I would look to cover those puts, because if the market corrected, it really could only hurt me. So yeah, you could even look at that. That's a great question, Manu. One of the very few times you will ever hear me say leg out of a strategy, all right? But in this case, yes, if the market rallied really hard and I'm looking at this, these calls being about a 60, 70 delta, which means they're in the money, these puts are going to be almost worth nothing, all right? And the delta adjustment isn't going to really hurt me or help me anymore. So I would cover that leg. You would buy the put side. Yes, I would buy the put side because I'm short these puts. And if these puts went from $1.25 or $1.30 or whatever down to like 10 cents, like, do I really care about that $10 on this trade now at this point? My deltas have adjusted, like I said, to a point of where if the market rallied all the way up and I said my calls went in the money, well, that would be like assuming that the market had rallied and now my 135 puts are on, right? I'm looking at a $10 wide, so let's just look at a $10 down to the 125s, 30 cents, right? At that point, I probably would try to cover this. I've gotten a full dollar out of it, I don't know if I'd squeeze it out any more than that. I've gotten to a point where my deltas are the same. I want to keep that at 50 deltas, right? Or 57 deltas in this case. I've increased my deltas, but you're doing a delta adjustment. You want to keep it at 50 of the underlying, then yeah, then cover those puts for sure. Just know that, when the market starts going down, you probably want to cover that trade totally. Okay. All right. Great question though, Banu. So I'm going to look to put this on tomorrow, actually. So if you're watching the daily market commentaries, keep your eyes out for that. Somewhere in and around close to those strikes. All right. Any other questions real quick? Otherwise, I'll move on. All right, cool. All right, you guys, if you haven't taken advantage of this is going to be one of the last times we offer this Christmas special, if you will. Basically, it's my options trading course where you get 4 different courses for $297, and it is a massive discount. I'll pull up the actual trade here because this one actually shows you're going to get a few extra ones. 4 courses for only the $297, and this is the bonus for that. You're getting 50 extra vaulted recording classes, so check that deal out. It is over there in the I'm going to put it over there. I'm going to put it over in the chat window. We've been going back and forth in the questions box, so this is going to probably give you a little notation that I threw something over there. And if you click on that hot link, it will give you right to this page straight away. If you're watching this on tape delay, you're going to have to pause this and punch that into your URL. But, this is great, you guys. I've been talking about all of this stuff where, you're getting volatility course. I go into detail in and around volatility, all right? How it affects you and how you can take advantage of it. Volatility can hurt you and it can hurt you fast. I talk about all of the nuances with volatility, so it'll help you sleep at night. This right here, the hacks, it's going to streamline your process. I have a lot of things with Delta, that we talk about, even like Gamma goes with Delta, little hacks to help you remember all of this stuff that I throw out in this. Probability of trade will make money and all those different hacks. Basics, this is a course on the history, the basics, drill down on the nitty gritty and how to remember those things a little bit easier as well. Trading around dividends, stock splits, all of those basics that we need to know about options if you're learning to trade. And then ultimately how I trade options. I talked about, I think there's better probability strategies for when implied volatility is super low or super high. Well, this goes into all of that and how to measure those successes throughout. So make sure you take advantage of this. That link is over there in the chat window. Otherwise, you're going to have to pause the URL and punch that into your URL. I see a couple questions coming up, so I'll get to that here in a second. Thank you guys all. Later webinars, I'm going to be drilling down on different option components, when and where I find those trades appropriate. Again, if you're watching this on tape delay, you can type that into your URL. It's not a hot link. Thanks for watching. If you have any questions, or if you guys see something that I should cover in a webinar, reach out to us at 310-598-6677 or trading@protraderstrategies.com. All right, take advantage of it. It's probably not going to be around much longer, and if you're watching it, the easiest way to do is click on that, give yourself an early Christmas present. Like I said, I know you can learn a lot of this stuff online, but they aren't going to give you strike location, you guys. They are going to talk about this in detail, about how you can limit different types of risks with these things. So I hope that that is added value to you, where you feel like, you know, $297 is actually added value. All right. So I'll try and get to these. Can you explain how to put the implied volatility into my watch list? Thanks. I actually have the code. I don't know if Thinkorswim is still doing it, but one of the things you have to do is go over and you'll have to check it out. But basically, you go over to the gears right here. There's a gearbox, and you hit customize and look up implied volatility, and see, it just gives you implied volatility here, which isn't what you want, because implied volatility is basically telling you what is at the bottom of this chart over here. It's going to tell you 11, and that's not what we need to know. Implied volatility is different for every single underlying, you guys. So because 11 seems low, Tesla would never get to an 11. Tesla actually would never get down to a 20, right? But, so what we're trying to figure out is 11 high or low for this particular underlying, and that's what implied volatility percent is. So for our subscribers, Stan, I actually have the code that you can actually go in, and I built this out. They have a blank over here where you can customize. So you can see I've gone to the customization and used one of those to come up with implied volatility percent. So reach out to us. We can get that to you. All right. So John, David, or John, what do you got? Did last week's webinar recording, having difficulty getting this recording? Check your spam, because recently some of my stuff has been going to spam. So if you guys haven't gotten that, then check that. Otherwise, yeah, we're trying to send those out there to the emails. Let us know if you're not getting those. I don't get I'm not in charge of that, John. So, I don't know what's happened there. If you haven't gotten it, just all I can say is reach out to us, let us know, and check your spam, because some of my stuff has been going to spam and make sure you click on it so it doesn't anymore. All right, guys, that's all I got for you guys, other than if you can't take that, take it easy.